Hey everyone, it's Shawn McBride. Welcome back to the Future Done Right show, where we look at geopolitics in the world and how it's impacting us, our investments, and our future. Today we're going to be talking about 2025 real estate investing. So I want to take a zoom out. I want to look at the macro market and what we're seeing from a broader perspective, how that's impacting it, and then move into the analysis of what that means for the real estate world. As always, this is not investment advice on this show. We're just teaching you information, giving you education and background so you can talk to your investment advisor, make your investment decisions. But I think what you're going to learn today is going to be helpful as you think about this issue. So we start by looking at the macro environment, right? I want to take a bigger picture of where we sit right now. And if we look at commercial real estate, it's pretty clear we have some issues. And there's a company out there called Castle Systems. They do the office keys for a lot of places, the electronic keys, and they keep track of who's coming to the office. And if you look at their statistics, obviously they had very light attendance in late December 2024, but even early December 2024, on peak days, they were looking at about 65% occupancy of offices. Now that's up slightly from prior years, but there's a lot of unused office space, and a lot of people are not going back to work. Now, some big companies are trying to bring employees back to work, but the fact is, it seems like there's way too much commercial real estate. There are bigger issues connected with that. If you watch Gerald Celente in his show, The Trends Journal, he really talks about how this can create a snowball effect on the entire economy, because some of these commercial loans are probably not going to perform. When people aren't renting the offices, then the companies that own the office buildings can't pay their mortgages. The banks have to take them back. There have been a couple pieces of real estate that have sold really cheap because they've been into a forced sale situation. And if this hits, we can have a snowball effect. So I'm very concerned about the commercial real estate market and how that impacts the broader lending and the residential real estate market. I'm talking primarily today about real estate investing in general, knowing a lot of you probably are interested in the residential side of this, but the commercial side is important to it. We also see the softening residential market. And I have a list here of 6 metro markets, according to Fast Company, that are actually in negative territory. So we actually have 6 major markets here in the United States where prices are going down. New Orleans, Austin, San Antonio, Tampa, Jacksonville, Texas, right? So we got a lot of Texas, a lot of Florida, a lot of South here that are going down in prices, where real estate's actually coming down. And that this is something that some people forecasted, that these real estate prices can't stay up forever. As an investor, obviously, you want to be capturing both generally cash flow from it, right? You're going to buy this building or this real estate and you're going to rent it out in general. And then you're hoping not only do you get cash flow from the rent, but that it appreciates. And at least in these markets, if you had bought recently, you're seeing negative territory here. Now, this may be counteracted by possible lower rates. In one of our recent videos here on the Future Done Right channel, we talked about interest rates and the fact that President Trump probably wants interest rates lowered, both to control the national debt and to try to spur the economy back to life. So those possible lower interest rates may fuel some price appreciation, right? It is long believed, and I think some statistics show, that if you lower the interest rates, the price of real estate go up. Basically, many people buy real estate based on their monthly payment, right? And if they can afford more, they'll pay more. So lower interest rates should mean some stimulus to the real estate market. But we have tapped out consumers, right? The consumer credit card delinquency rate, if you look at it at the St. Louis Fed, it is going up. We're over 3% right now, so that is moving in the wrong direction. Not necessarily terrible by historic standards, but we are in tough territory there. Same with mortgage delinquencies, also below historical numbers. If you look back many years, you look at the housing crisis, 8, 9, we're below those levels of delinquency, but we're still over 1% delinquency on mortgages, and that means a lot of people aren't able to keep up with their house payments. Again, that creates downward pressure on the real estate market. And another big issue out there now for real estate, and I think everybody has to keep in mind now, is the regulatory issue, right? There was a time where real estate seemed like a really safe investment. You could just jump in there and get rents. Now for that 1 and 2 and 3 owner property, the people that are just getting in and just getting started, haven't built enough of a rental portfolio to be diversified to manage the risk across multiple properties. What we saw during the pandemic, where landlords were essentially forced to continue to rent their properties even without cash flow coming in because of some of the emergency laws that were passed throughout the United States, that really puts a bigger risk on real estate investing, right? Could we have another outbreak? And there's already talk right now about other possible situations coming along, plus insurance. As I'm recording this, we've got the terrible wildfires raging in California. They appear to be doing a lot of damage, and that is probably going to have an effect on the national insurance market, right? Just because you're not in California doesn't mean necessarily that your insurer is not going to re-examine their risk profile and want a little more money from everybody, because now they're probably going to have a massive loss. We have the hurricanes in Florida, we now have the wildfires in California, we have other random events throughout the U.S. All of that points to potentially higher insurance, and at some level you're going to have to insure the property, right? Maybe your renter's insuring the contents, but ultimately you probably are going to have to pick up the bill to insure the overall structure. And it's hard to say if prices are going to go up or they're going to go down. So I think right now it's a wait and see. Personally, I don't think it's a great time to launch heavy into real estate. It's a possibility. It's something you can look at. Maybe you add 1 or 2 properties to diversify your portfolio if you have stocks and precious metals and other things, and you just want to add something to it. Maybe that makes sense. If you were going to go into real estate as your primary source of income, if you want to build the passive income from it, the risk factors right now with the economic uncertainty, the geopolitical uncertainty, and those types of things, to me, points towards maybe being a little more conservative. What do you think? Join me in the comments. Let me know what you think. Are you going headlong into real estate investing? Do you think it's a great time for real estate investing? We'd love to hear your thoughts. Share with your friends. Subscribe if you enjoy the channel, and check out our other videos. I'll see you for another video soon.